underlying idea. It's that you never get to a point where the economists or the government regulators thinks that things are so good that it's time to pay the debt down. So the only time we actually had anything close to that, and during the Clinton administration, it was really sort of jury-rigged by the dot-com bubble, which was unsustainable, and you know, so that was not gonna persist either. So this is the problem, is that we have all the Western economies, you know, we have such an attenuated idea about the time. And so you hear, I don't want to mention names, but so you have really, really smart economists, much smarter than I, saying, well, you know, since the 1940s, we know that Keynesian economic works. I mean, really? In 60 to 70 years, we know that? 70 years, that's nothing. In terms of the spread of time, we can look back at economic history, and history tells us that governments that chronically spend on a deficit basis eventually go broke. They eventually go broke. So anyways, the issue that we're dealing with here is Western Europe. And so we've got a number of countries running big, big deficits. And that includes Greece, but includes other countries that are at risk as well, including Ireland, Portugal, Italy, and Spain. You probably have seen the recent downgrades that some of the rating agencies have made with respect to the countries and to the banks and so forth. And this is all sort of preparatory to the knowledge that the Greek government is eventually going to default. The question is then, from an economic perspective, what happens next? Can there be an orderly resolution? Can you have an orderly default? In other words, where everybody says, okay, well, so Greece, everybody is going to get 60% of what the debt is for Greece or whatever it is, and life goes on, and we're going to have a big fund in order to keep anybody else from going bankrupt or having to have to go through a default. Is that possible or not? I don't know. Nobody knows. We haven't been here before. But it's possible that once that happens with Greece, it starts to happen elsewhere, because you get this contagion or panic effect where everybody says, let's try to be polite here, the heck with this. I don't want to own Italian bonds. I don't want to own Portuguese or Spanish or Irish bonds or maybe even UK bonds. I don't want them. I'll go buy U.S. bonds. Go figure why. Who knows why? But I'll go invest in those. I'll go a whole dollar, something, anything, but not those countries' sovereign debt. So if you get that, then you could have a real problem, because then you get this sort of domino effect that percolates through societies, through nations, as well as even into the banks, perhaps even into the United States. So what all the banks, so let's get back to valuation here more specifically. What is the valuation issue here? Is, again, just like up here, you've got all these banks that own this debt of other countries. And the question is, what's going to happen to that debt? Is someone going to bail them out? Is Germany going to step in and backstop the losses that they have in these banks? In other words, they're basically going to make good the losses so that the banks don't have to absorb the losses of a Greek default on the debt? Or are they just going to be exposed? If they're exposed, then what are they going to have to do? Well, many banks will then not be properly capitalized. So suppose, let's look at a kind of a simple example here. Suppose we say that a bank has to have, I don't know. I really have no idea what the capitalization ratios are, so I'll just make something up just for an example. So suppose we say it has to have 20% of its total assets in capital, in equity, right? Well, what happens if you have to write down assets? Well, think about your kind of equation. Assets equal liabilities plus equity, right? So let's just suppose, for example, this is 100, and this is 80, and this is 20. So here we have a company that meets our criteria. We can do it in terms of debt too if we wanted to, but it doesn't matter. So let's suppose that some of these assets are Greek bonds, investments in Greek bonds. Now we haven't sold them, we're just holding on to them, but now we've got to write them down. What is that going to do? Well, we're going to take off 10 here, suppose. I'm just making up numbers again. We take off 10 here. Well, where does the other 10 come off? Remember, this is the accounting equation. Does it come off of here? No. It comes off of here. So where do we end up now? We end up with 90 and 80 and 10. Well, guess what? 10 is not 20% of 90, right? 18 is 20% of 90. So what does this bank got to do to stay in business? Assuming that 20% is the capital adequacy on assets ratio. Guess what? This bank has got to raise another 8 billion euros, 8 whatevers, in order to stay in business. And so this is the issue that's facing the bank. So what do the banks want to do? The banks, of course, want to do things like say, well, wait a second, we don't want to write that. We don't know that the Greeks are going to go broke, right? Maybe they won't. So they're trying to put this off. And everybody else is trying to put this, the Germans and the French are trying to just kick the can down the street. You know, maybe a miracle will happen and we won't have to do anything. Something miraculous will somehow save everything. Maybe business will turn up. Maybe the Greeks will get serious and come up with a way to seriously begin to cut their deficit, which seems extremely unlikely at this point. But in any case, at some point, that's not going to be good enough. This is going to happen. And the question is, when are we going to make them do this? Now, Dexia, of course, I believe just a few weeks ago, wrote down $12 billion. And so they figure, how are we going to continue in existence? Well, we're going to break them up. We have to break them up. We're going to have them backstopped by other governments' investments or guarantees, something. Something's got to come along here. But this is exactly the evaluation issue. And you can see not only how valuation affects the accounting equation, but in terms of things like ratios and capital adequacy and so forth, how the accounting for it actually is driving the economic implications and economic consequences for these banks. So these are two examples of some real serious issues related to investment valuation that we're facing that have practical implications and are perhaps the most serious issues facing Western economies today. And that is the end of Module 2.